We've talked about, that balance of investor protection versus capital formation. And one of the ideas that came out in the last number of years was crowdfunding. This idea of making it easy for small businesses to raise money online from a large number of investors in small increments. And I'd like to discuss why, in your guys' opinion, it hasn't really worked over the past number of years.
You can't just throw a whole bunch of investments up on a website and then expect everybody's going to show up clicking and start investing. Somebody has to take the role of moving that investor to action, getting them onto the website, getting them informed, helping them make the decision that's right for them. So I actually think that the idea of crowdfunding makes sense, which is there's lower disclosure standards. You can be actively raising money in the marketplace without being registered. There's no suitability, minimal KYC, that sort of thing. I think that makes sense. I think the biggest mistake that was made is that the idea of crowdfunding wasn't made to be technology agnostic. They said it has to be solely through an online crowdfunding platform. I think you would free up a lot of capital if you kept even the limits that are in place around crowdfunding and just said, if you're a dealer and you want to go and raise money for these small $1 million offerings, your advisors can do that. And they can do it within the exact same rules as if they are a crowdfunding platform, but they can be out there and actively speak to people about these investments and put them in front of their investors. I think if you did that, you would actually see it start working and people would get those investments because it's treated differently than the conventional retail exempt market securities. But if you don't approach it from a technology agnostic standpoint, you've inhibited the innovation that can come with it, and people just have no choice but to say, hey, here's my website, I hope people click on it.
I think the challenge that I saw with it, I get conceptually it's a good idea, but it all comes down to dollar amounts and who the individuals are involved, right? If you're asking a seasoned entrepreneur to go limit himself to a couple $1,000s, give or take, and I know the numbers have moved, from hundreds of investors, that's a hard pill to swallow.
Well, I wasn't a big fan of the crowdfunding in the beginning because I find that the whole idea was a bit like a lottery ticket. Let's throw $100 and see what happens. The other aspect of it is to be able to try to get it in large scale. I mean, there's a lot of good ideas out there, but they should remain ideas, some of them. There's still an economic factor. I mean, we're still in a capitalist system. There still has to be something that generates a profit at the end of the day. And going into a VC environment or to some sort of, to an extent, into an exempt market dealer provides you that insight.
Here's the reality. Corporations have a life cycle. Entities have a life cycle. They start off small. They start off in their infancy. They need a little bit of money to get going. Then they grow. And some of them die on the vine and others continue to grow. And then some of them accelerate and they eventually go all the way through to becoming a public company and they're $1 billion market cap and they're free trading stock. But they start somewhere. They start in the basement. And if the rules aren't right, that company doesn't start. And that could be whether or not their EMDs are absorbed by an SRO. That could be whether or not there's the right prospectus exemptions. Could be whether or not the prospectus exemptions are too tight. But our current reality allows regulators provincially to adjust those rules to tailor the marketplace and as they see a need for adjustment. Where when you give that away to a single entity and empower them to be in charge, you lose that, right? And that's what we're talking about is we play down here in the trenches where companies start. We play in the garages because that's where Apple started and everybody else. But that capital is what gets things going. And if that capital isn't formed, then there is no Series A, Series B, Series LMNOP that's raised for these companies because they don't get off the ground to begin with.
And that's so important to bring up because it's that group that rarely has an advocate in their corner trying to tell everybody, look, if you make this change to regulation, this is who is going to get hurt. It's this store on the corner looking to start up. It's this person with a dream in their garage. They're the ones being punished. The exempt market is interesting because it goes from those entrepreneurs and startup angel capital all the way to huge, multi-billion-dollar companies doing roll-up strategies, real estate investment trusts, equipment financing, all sorts of different things. And I think those big private funds will still find a home, really no matter where the regulation goes. They're just so capital intensive that oftentimes it's more efficient for them to raise money in the exempt market and they will continue doing so, and even the IIROC dealers, other people will find a way to raise money. But if we continue to treat everybody who's down at the startup level, the people with a dream in their garage, the same way as a large billion-dollar fund, they won't have a place to raise money. And it's great what you're doing is meet with those people and help them nurture that dream. You couldn't IPO a person with some background. You would need to have a business plan and all the rest. And if you help take them through that process, it's similar to what you'd see out of VC fund.
Yeah, and I see, like even I speak to friends, family, business associates in the US, and they actually say, wow, they're to be able to say that you can democratize alternative investments to a certain extent, obviously suitability and all that stuff, but just we're on the right track, and we shouldn't lose that. I mean, the US doesn't have what we have, and they want to start something. It goes into a network of very wealthy people that are putting money down, and that's what happens. So, I mean, we have to find a way to protect this industry, because I think it will thrive over time.
If anybody has any final thoughts, now would be a good time to chime in. Nancy, do you have anything final you'd like to share?
I want to add that I do actually want to, I mean, I know we've already addressed this in the conversation with our regulators actually reaching out to industry to start a dialogue. The committee that Phil and I are both on with Alberta Security Commission is a wonderful example of that, to try to give insight in dealing with what that balance is. Because, and I like the term that you use, I mean, technically speaking, we are the ones that are in the trenches, and we're bringing these small companies to being larger companies. This is economy. This is what it is that we do in every country across, well, hopefully every country across the world. But if you make that too difficult, one point I did want to add just as an add-on is when you have some of these companies that they're at the garage level and then they move up for their first, second round, and now they're at a stage where they're wanting to raise $25 and then $50 million. The job creations alone are a wonderful thing to look at, but now they start getting a little bit bigger. They're still not quite ready to go public. They want to stay in the private market, but their cost of capital, their cost of raising money becomes too difficult, to the point where we've actually seen examples where there are issuers out there borrowing money because it's cheaper for them than actually raising the capital. And this sort of takes away from the efficiencies that we would want to see with the companies that are associated with, small business and what have you.
Well, I mean, the reality is that the exempt market dealer business model from day one has not been all that economical. Some people have done well off of it, but it's a challenging business model to make work. And the cost of capital often is what it is, because that's what the dealership needs to keep its doors open, not to get rich. So the cost of capital is something that's an ongoing challenge for the dealers and the issuers. And regulation speaks directly to that. There's a direct relationship between the amount of rules, the amount of systems and people that a dealership has to have in place, and that all has a trickle-down effect. Doesn't mean there shouldn't be any rules, of course there should. It's trying to find that sweet spot, which I think is a moving target that probably will never once be hit. Phil?
It's sort of weird to put out like a call to the industry, but I just hope that there's a lot of collaboration around these issues and a shift culturally in Canada to start regulating with two hands as opposed to just one. I mean, every step that we make in a regulatory environment to try to shore up an issue or protect somebody typically leaves somebody else behind. And that doesn't discount the fact that we do need to have greater investor protections or greater capital formation, but at the same time, looking at what the side effect of that decision is important. And I don't see why we can't start taking an approach where we say, you know what, we're gonna tighten this part up and funnel people over here, but now we have to create another valve for these people. And I mentioned earlier around the self-certified investor exemption, like that's exactly the kind of thing that we need to be doing. We're like, oh, we're going to tighten up, the exemptions. There's more detail in an offering memorandum, and that's something that had come out. Now we're also going to make sure that a whole new demographic of people can invest in this area, so that the people that aren't going to be able to continually graduate up ever increasing disclosure, ever increasing regulation, have other safe environments to raise capital. We have to lose the tunnel vision, and it has to stop being a battle between, capital formation or investor protection. And it has to be both at the same time in concert. And sometimes that means people are going to have to come up with new ideas and innovate as regulators, not just as industry.
to me, the key to good regulation is it's not done in a vacuum. It's done on a collaborative level with industry. And that starts with the industry itself collaborating, which is something we do through the Private Capital Markets Association. So we encourage anybody who's seeing this to reach out and become a part of that discussion, because we're the ones that get to have these conversations with the regulators that maybe we don't always get what we want, but they do help form better policy, because our message to the regulators comes from the street. It comes from the people that are raising money. It comes from the people that are utilizing that money. It comes from the investors that are getting into these opportunities. So when anything is done inside of a vacuum, it usually doesn't go well. We've seen it. So we really are trying to encourage an environment of collaboration amongst industry, even more so. And then from there, we as a larger collective can have these discussions with the powers that be around Canada and create a better environment for issuers, dealers, and most importantly, investors.
On a final note, the only thing I would like to say is, as the chairman of the Private Capital Markets Association of Canada, to encourage people to come in, be part of the organization, or at least to come have discussions with us. It's very important. I think the private markets are going to get more traction as we go forward, and with the regulators that are looking for more feedback, that there's not much maybe information and data to be able to make better decisions. I think collectively we can inform, we can be a voice that we will be able to get out there and protect this industry and pretty much offer entrepreneurs an environment where they can explore opportunities to get capital, issuers, dealers, and obviously investors, to be able to have a voice or an organization that is looking to protect those interests and thrive over the next decade.
The Private Capital Market Association of Canada also acts as a wonderful information resource. We're all looking at data, whether you're an exempt market dealer, you're an issuer, or just simply an industry participant. You're looking for data. And one of the things the members have thoroughly enjoyed throughout the PCMA, Private Capital Market Association, has been the subcommittees created. There's a dealing representative committee. So for dealing representatives out there that are new to industry and they're trying to get information or even learn how to thrive or collaborate with peers, they can actually reach out to that committee to get that information or get the support that potentially they may need and from a collaborative ability.